Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, May 19th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures are down. They were worse overnight, but currently we still have a little bit of ways to go before the market open, a couple hours. Currently we've got Dow futures down about 270 points. S&P 500 futures down 34, NASDAQ futures down about 110. Overnight, they were a lot worse, though. I know at one point I saw the Dow down over 400. I'm not sure if that was the low overnight. NASDAQ futures were down close to 200 at one point. So we have come off of those lows, but it does look like we're going to continue the selling that we saw on Wednesday. It was a very rough day on Wednesday, and kind of surprising to me, given that we are heading into options expiration week. And we still had a lot of in-the-money put premium on the table. That's a lot higher today than it was yesterday after the selling we saw. Of course, we did see a little bit of a rally over the past few days heading into yesterday. So maybe some of the options issues were taken care of, but still I would have expected to see a little bit more strength in the near term. But that is not what the market did yesterday. It's not what it looks to be doing this morning. So got to batten down the hatches, because the intermediate term remain. I said all along, we're in a cyclical bear market. We've got the numbers now pretty much to prove it. Everybody, well, not everyone, but there were plenty who were waiting to see if the S&P 500 would go down 20%. I think we got pretty close. I don't know if we quite got there. Maybe it was 19, but it has been a pretty rough road here in 2022. Let's go ahead and go through the agenda for today. Going to be an interesting show. Got a lot to go over. Got a big draft, what I call our portfolio draft tonight. So every 90 days, we have 5 portfolios, and we pick 10 equal weighted stocks to go in each of those 5 portfolios. And that's not an easy task in this market. I can promise you that. But I'll talk about things because we've changed things up a little bit last quarter, probably going to again this quarter. But I'll talk about that in just a minute. But for the agenda today, we're going to start off with the daily market recap, get into talking technically. Safety versus growth. That's going to be a big theme for tonight and the draft. Earnings spotlight, and then the 3 you must see. But before we get into any of that, let me take you over to earningsbeats.com. All you have to do is go over to earningsbeats.com, scroll down, and you'll see a couple things. I'll come back to this in just a minute. We're having our best special of the year right now for our members, or those who want to be members. But I just wanted to mention you can subscribe. I'm not sure why we're not seeing. I've seen this recently. I'm not quite sure what is going on. Let me try to update, see if this. No, still not showing. Usually there will be a box here for name and email address. I'm not sure why it's not showing, but we'll make sure that is there later. But you can subscribe to our free newsletter simply by providing your name and email address. There's no credit card required. You can unsubscribe at any time. And this is a newsletter that I publish 3 times a week, Mondays, Wednesdays, and Fridays. So normally we try to get it out around 8:30 in the morning, so you have it about an hour before the market opens. Normally just a couple paragraphs and a chart. So pretty simple read. And it could feature anything from earnings, gaps resulting from earnings, candlesticks, relative strength, trend lines, moving averages. I mean, any of those things, price and volume, sometimes big breakouts, breakdowns, that sort of thing. But anyway, it's just a nice little chart to get your day started. If you're a trader, you like to, look at the market quite often. I think you'll enjoy the EB Digest. And it'll give you quite a bit of knowledge as far as what we do and how we approach the market. Also, because we are going to be doing these drafts, let me go over and show you the historical performance. So here's our historical performance since inception of all of our portfolios. You can see the model portfolio up 118.4%, which is way down from where it was. However, that's going back to November 19th of 2018. So that was going through the trade war issues, the pandemic, and then what we've had this year, the cyclical bear market. And so 3 years and 6 months later, here we are up 118% through all of that. I think that's pretty good, especially when you consider that during the same period, the S&P 500 is only up 45%. We focus on growth normally. I'm going to talk more about that in the show here. But yeah, normally we are into the growth area. The aggressive portfolio also normally is very high growth oriented, up 81% since May of 2019. So that was a little bit before the pandemic hit. But we've gone through the pandemic in a cyclical bear market and, of course, the huge recovery, but up 81% while the S&P is only up 37%. So that's pretty good. Income portfolios lagged a bit. It's having a pretty good quarter this quarter, but it's lagged for a bit. But I would expect that too when you're in a secular bull market and the market goes mostly higher, because these dividend payers, many of them are going to be more defensive. They're not going to be the high flying growth that tends to lead the S&P. So you would expect that's going to lag a little bit. The strong AD got out of the chute really well after the pandemic. We started this portfolio after the pandemic began. It got off to a really good start, but now you can see it's dropped below the S&P 500, 10% versus 34%. So this one hasn't done quite as well. This quarter, I'm actually pretty proud of these results, only because normally we are into growth stocks, and growth stocks have been decimated. So the goal here, and by the way, we are 100% invested in these portfolios at all times. That's one of the things that we do, because the portfolios were designed for folks who wanted to invest in the market kind of from a long-term perspective, always in, but rotating every 90 days, not actively trading. A lot of folks don't like to do that. So we put these portfolios together mostly based on relative strength to show how you can outperform the benchmark. And for the most part, we've done that. But I can tell you the last year, and especially the last few months, very, very challenging. We did make some changes in our portfolio draft back on February 18th. 19th was a Saturday, or maybe it was, I don't remember when. 18th may have been a Thursday or Friday, but whenever. This was basically February 19th to May 19th. And so today we will wrap up this quarter and then start a new quarter with the announcement of our draft picks tonight for each of the portfolios. But looking at this, I want you to just keep this in mind. In fact, I'll come back and show you this in a bit, because I want to show you how some of the other growth funds out there have done this quarter. We made some changes, and I've got probably in this model portfolio 3 or 4 growth stocks, and that's what, of course, killed the portfolio. There were some others, though, in that portfolio that held the portfolio up pretty well. So including, energy, materials, that sort of thing, where the market has been much better on a relative basis. Anyhow, we'll come back to this because I want to show you the performance there and what making a few changes back in February did relative to some of the growth funds that are out there. But let's move on. Let's move to talking technically. Daily market recap. Wanted to go over the action from yesterday. I can just tell you it was really, really poor. Dow Jones Industrial Average down 1,164 points, down 3.5%. S&P 500 down 165, 4%. NASDAQ was down 566 points. That's almost 5%, 4.73%. Mid caps down 94, almost 4%. Small caps down 39, a little more than 3%. It was just ugly across the board. Looking at the sectors, it didn't get any better. Discretionary stocks down 6.5%. Staples 6.4%. So they're your consumer stocks, leading to the downside. If that doesn't reek of recession, I'm not sure what does. Consumer names really getting hit hard. Technology down 4.5%. Industrials down 3.7%. Communication services 3.27%. So about 3.25%. But there are your 3 really aggressive groups: communication services, technology, and discretionary. Throw in the other consumer group, throw in industrials. I mean, this was a bloodbath on Wednesday. All 11 sectors were down, and 10 of the 11 were down at least 2.5%. The only one that held up fairly well was utilities, defensive utilities group, which was down less than 1%. But it was just bad everywhere. Really not a whole lot more to say there. It was just a bad day. Looking at the 10-year Treasury yield, we do have a few economic reports out later this morning. Initial jobless claims will be out a little more than a half hour from now. May Philadelphia Fed manufacturing index will be out. April existing home sales out later this morning. Initial jobless claims, I think, is interesting because last week it jumped up over 200,000 to 203. And the expectation is for it to drop back to 197. But I'm thinking that jobless claims will begin to go up. We'll see. Anyway, estimates are 197 to go back below the 200,000 level. May Philadelphia Fed Manufacturing Index expected to drop to 16.1. April was 17.6. And then April existing home sales expected to drop as well. March was 5,770,000 units. And we're expecting to see that drop to 5,650,000 units. So 5,770,000 to 5,650,000. So yeah, not great action there. Not expected to have very good reports today. And housing reports have just been poor to begin with. Looking at the 10-year Treasury yield, you can see yesterday, big drop, big reversal. We were up over 3%, came back down to finish at 288, 289. I think we're going to probably stay in this 265 to 316 range for now. A break one way or the other, I think, would be big news. Other than that, just look for consolidation. All right, talking technically. So I'd like to start off here with the S&P 500. And you can see there's that big red-filled candle. It was an ugly day. Volume ticked back up again on the selling, at least on the S&P. Not as much on the NASDAQ, but definitely on the S&P. The big level to watch here is 3,900. That's where we gapped down to back on Thursday of last week. We opened at 3,903. We got as low as 3,858. But 3,903.95, that was the open. And we went down below. We came back up through the open. So that right now, 3,903 is the level I'm going to watch. But as I said back at the beginning of the year, my worst case scenario back in January was 3,500 on the S&P 500. So that's still another 10% away. And at the rate we went yesterday, it wouldn't take very long to get there. But I think if we get there, we're going to see some off the charts sentiment readings, which will help, I think, mark a bottom. But we'll see. I mean, could we go below 3,500? Sure. I mean, we've got some horrible news. You know, when we were at 4,800, you have to say that was a pretty bold pick to say that we could go down to 3,500 based on the weakness that I saw coming. So now that we're here at 3,900, it's a lot easier to say, well, we're going to go below 3,500. Back when it was 4,800, that was, like I said, pretty bold call. But I said 4,300 was the minimum. 3,800 was kind of what I was expecting. 20% on the S&P 500. We're almost there. And then I said, if things really got ugly, sentiment turned really, really bearish, got to an extreme, maybe 3,500. And I'm going to stick to that. I think 3,500. I will be adding. I can tell you that at 3,500. And what I'm doing in one of my retirement accounts is simply using the QQQ, because I believe we're in a secular bull market. I think some of these growth stocks have been ridiculously oversold. Disagree with me, that's fine. But I think they've been ridiculously oversold. But that's the way the market works. When we go into these bear markets, you know, I remember at the beginning of the year, someone wrote to me and said, well, I know you're bearish, but these growth stocks have already been hit so much. They're not going to go down anymore, are they? And I'm thinking, they're going to lead to the downside. I mean, that's what happens in a cyclical bear market. You get out of growth. I mean, if you're going down because of a recession or inflation, growth stocks are the ones going to get hit the hardest. And it has been a bloodbath in the growth area this year. Anyhow, the S&P 500 right now, after closing at 39.23 and based on where futures are, we could come up. I mean, futures have been coming up overnight. Maybe we get back up and we hold 39.03 on the open. I don't know. But that would be the short-term support area. If we fail to hold that, well, I mean, 3,500 starts to look pretty doable. All right. Let's go into safety versus growth. So probably no one out there is too envious of me tonight, having to pick 50 stocks to line 5 portfolios in this environment. I'm not looking forward to it. What I have told members throughout the year, if you're a trader, I think cash is king. And that's where I've been most of the year. I trade from time to time, But I'll be honest, most of my trades this year, and even in the daily market report, many of the trades that I've highlighted have been in the defensive area, which I normally wouldn't even touch in a advancing market. But defensive stocks have held up the best. Utilities, consumer staples, even though yesterday was a rough day, consumer staples, real estate, healthcare. These are areas that have done very well. And I'll show you a few relative charts in a minute that'll help to illustrate that. But let's look first. This is the IWF versus the IWD. This is Russell 1000 growth versus Russell 1000 value. Large cap, these are large cap growth versus value names. And we started this downward journey back at the end of November. I mean, if you recall, this was one of the things I talked about at the end of December, that the market was going up, and it was not going up being led by growth stocks. Growth stocks on a relative basis were going down while the market was trying to make a new high, or while it did make a new high. Defensive groups led the entire month of December. All 4 defensive groups were in positions 1 through 4 on a month-to-date chart when you looked at all the sectors back at the beginning of the year. At the beginning of January, when we look back over the last month, and let me go back here and show you this. Here was the S&P going up. Normally, when the S&P is going up, you're going to see technology, consumer discretionary, and communication services leading. This month, when we looked back, the 4 leaders were real estate, healthcare, utilities, and consumer staples. I'm not sure which order, but they were the top 4 spots. And they were by far the top 4 spots. That's Wall Street repositioning into defensive areas. When you see money rotate like that, when it's leading the market to the upside. Now, usually, like I can promise you, if we had looked back in October here, when the market's going down, defensive groups are going to lead. That's normal. When you're going up, it's not normal for defensive groups to lead. So you've always got to be careful. And I wrote about it. There are articles. Go back to the end of December, early January to my blogs. And if you're not sure about the blogs, by the way, or how to get to them, I have 2 blogs I write in. I write in Chart Watchers. Chart Watchers, I write in here with a number of other great friends, great analysts. I write every other week. My partner, John Hopkins, writes every other week. So we're in there between one of us, in there one of every 2 each week throughout the year. But there's John's article from last week. But if you go in here, here's my article from 2 weeks ago. Talking about sentiment. I mean, this is the one, we needed to get the sentiment up. I talked about this at the beginning of the year. We needed to reset the sentiment. Sentiment was way too bullish. We needed to reset the sentiment. And that is the scariest one of all, sentiment, because that's usually when it's in panic mode. When you get to the level you need in sentiment, it's usually because you're in panic mode. Anyhow, one thing I want you to be aware of, at the bottom of all of our articles, whether it's me, Arthur, Greg, whoever you're following, Julius, Aaron, at the bottom of all of our articles, you can see this spot where you can subscribe. Free subscription. StockCharts doesn't give your email address to anyone, as far as I know. All you do is type in your email address, completely free. And then as soon as we publish our blog articles, they'll be sent to you. I used to do in my Trading Places blog. So here's the Chart Watchers. Let me go over here down. If you scroll down on the menu, Trading Places is my blog my blog articles. That's where you'll find them. When I, prior to returning, excuse me, hold on one second. Prior to returning back to earnings beats as its chief market strategist back in, I guess that was 2019, I was writing a blog article every single morning in my Trading Places blog. And I was publishing literally almost exactly at 9 o'clock every morning. I really tried to get it out at 9 o'clock because I wanted to get it out a half hour before the market opened. And so 9 o'clock every day, you could count on my article. You didn't need to subscribe because you could come in at 9 o'clock and there's my article. But now I don't know when I'm going to be publishing an article, to be honest. I mean, I've got a lot going on. We do a lot of research for our members at Earnings Beats. It's really hard to get in here and write articles as often as I used to. So you can see a lot of times it's a week. I think there were at one point, yeah, right here, this was probably the longest I've ever gone without publishing an article in here. It was 12 days, almost 2 weeks. But I try to get at least one out and maybe 2 out a week. But if you subscribe, again, pull up the last one, go down to the bottom, and there's that area where you can sign up. You can subscribe. So just make sure you subscribe for the articles, and then you'll receive them in your email as soon as I publish. And then you don't have to worry about looking to see when the articles come out. If you enjoy reading my articles, there's a lot of different analysts, a lot of different takes. I'm sure I don't appeal to everyone at StockCharts. Some of you maybe kind of think a little bit like I do, or like my line of thought and reasoning. But there are plenty others of just super technicians at StockCharts. So I would encourage you to check those out. All right. So as far as safety versus growth, it's really hard. This is a ski slope right now. This is growth versus value at the large cap level. Yesterday, we set a new low. I mean, it's really hard. This is why growth stocks are killing portfolios. And this is why the ARK funds and the IBD 50 are getting killed. It's not, it's not all of a sudden these folks aren't smart. They don't know how to pick stocks. The market is not conducive to owning growth stocks. This is not the environment right now that you want to own growth stocks. So there's a dilemma for me, because I think that we're going to bottom, and I think we're going to bottom probably over the next few months. And, we could bottom next week. If we panic and have a big sell-off, we could set a bottom that we don't go back down to. I don't know if it's going to be next week or maybe a few months from now. I think we're probably going to go lower, and sentiment is going to turn extremely bearish, where people just get to the point where they can't take it anymore, and they're going to throw in the kitchen sink, and that's when we're going to bottom. I don't know when that's going to be. So putting in these portfolio stocks right now and holding them for 90 days, which is what we do, is a daunting task, to say the least. But when I look at this, and I look at the XLY versus the XLP, this is consumer discretionary versus consumer staples. In a secular bull market, we normally have this going up. Let me show you the last 3 years. I mean, here was the drop during the pandemic. And then look at this. This ratio is one of my favorite ratios, because it normally goes right along with the S&P 500, and many times will give us signals before we see the signal in the S&P 500. Check this out. Mid-November, we topped. Remember that S&P 500 chart I showed you where we were increasing in December? Look at the money rotating out of discretionary and going into staples over this 6-week period. And that hasn't stopped. I mean, we've been in free fall. Now, I don't believe we're going all the way down here. I would be really surprised if we get down to that panic low from 2020. So I think between here and there, I think we're going to bottom. I don't know exactly where or when. What I'm hoping happens is that the S&P 500 keeps going down and we see this ratio start to turn back up. That will tell me Wall Street is, even though we're going lower, Wall Street is starting to turn, rotate more into aggressive areas. That would potentially be an early warning sign. So we want to watch for that. Moving on, still within this safety versus growth area, but moving on to a little different topic. Here are the defensive areas relative to the S&P 500 right now. Starting in November, look at healthcare. Crazy, right? Crazy relative strength. Consumer staples since November. Real estate since the beginning of 2021 been in an uptrend. It's had a rough last month or so, but still the overall uptrend in play. And then utilities going straight up. I mean, I don't need to do much more analysis, do I? I mean, I think we know where the money's going. Now, that doesn't mean these groups are going up, by the way. Look at utilities going up the last month on a relative basis. It's been going down. but it's only gone from 77 to 72. So we've gone down less than, 10%, maybe about 7% or something, maybe 8%. Whereas the S&P's probably gone down twice that over the same period. So that's why the relative strength is going up. Doesn't mean you're making money, just means you're outperforming the S&P 500. And honestly, that's my goal anytime. Now, this quarter, like I said, it's been kind of rough, but I want to go over with you real quick. I showed you our performance this quarter. I want to read to you what the ARK funds did this quarter since February 19th. So I went back and I got their performance during this period. And I want you to look at our percentages. Here's the ARKK down 36%, ARKG down 31%, ARKW down 35%, the 50, IBD 50 down 18.7%. So, we're still a little growth oriented, but we calmed it down a lot this quarter because in this environment, while, we do think there could be a bottom, or there probably will be a bottom at some point, we don't know when it is. And with those ratios I just showed you going straight down, I think we've got to be somewhat careful and safe in these portfolios, at least for now. So if you want to come in and go through this draft, I'll talk about all the things I've looked at, kind of set up the environment, and then go through all the stocks and why I picked them. You can subscribe as a trial member. It's a free 30-day trial at Earnings Beats. And like I said, we do have our special going right now. So if you click on this, it'll bring up a page. It'll show you all of our special deal. But you can sign up for 30 days. And if you like us after the first week or two, you can use this special to get a great deal. And you still get the rest of your 30 days for free. We would just tack on whatever you want to the end of that 30-day period. So it's almost like you're getting an extra bonus month in addition to all these bonus months here. Anyhow, that's that. Come join us at the bottom of this page. By the way, you can sign up. Love to have you for tonight's event. All right. I wanted to go through and just show you a couple of charts of stocks that have been, these are the worst performing NASDAQ 100 charts over the last month. Align Technologies has dropped 35.8%. I'm pulling it up on a weekly chart just to see if there's anything here that makes me think, okay, maybe we're ready to bottom. Like, is there a positive divergence? No, we're going straight down. I mean, we're way oversold. At some point we could definitely bounce, but this is an unhealthy chart. The next one is Crowdstrike? Actually, Align was the 5th worst. I'm going to go through 5 of them with you really quick. Crowdstrike breaking down, not interested there. DXCM, this is Dexcom. This one just broke, or well, it broke out here above this 290 to 300 level, and that's about where we are. I give this one a little bit more hope than the others. Team Atlassian software company getting crushed, looks horrible right now. Again, very oversold. And Okta, another software company, very oversold, but showing no signs of a bottom just yet. These are all areas that probably will bounce back strongly if we ever get that capitulation day. Anyhow, that's what I had for you for today. Actually, I never did the earnings spotlight. I do want to just mention Cisco. Cisco's down just a bit here in pre-market. Let's take a look at it. Cisco down almost 12% in pre-market. They missed on their revenues. They did barely beat earnings though. Anyway, that's it for me. Listen, have a great day and happy trading. Be back next week. Take care, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment. And if you're new to the channel, you can